Thank you for watching. Please like and subscribe to our channel.
Welcome back to The Explainer. Today, we're diving into a really fascinating piece of analysis from a regional stock report dated July 2026. We are looking at what is honestly a classic investment mystery. Imagine a highly profitable industry leader, absolutely dominant in its sector, yet somehow trading like a budget brand. The company we're talking about? Bereshit Virge, AG, better known as BMW.E. Our goal today is to break down this comprehensive analysis, zeroing right in on BMW's valuation, checking out the technical charts, and digging into a very specific trade recommendation for the premium auto sector. Okay, let's just get right to it with a number that should instantly grab your attention: 30%. According to the July 2026 analysis, BMW is currently trading at a massive 30% discount to its fair value. It presents this totally fascinating valuation paradox. I mean, how exactly does a premium automaker with industry-leading quality metrics end up being so severely discounted? Well, that is exactly what we are going to decode for you today. So here is our roadmap for the explainer. We'll start with 1, the undervalued giant, 2, by the numbers, 3, charting the technicals, 4, catalysts versus risks, and finally 5, the trade strategy. All right, kicking things off with Section 1, the undervalued giant, decoding the valuation paradox. Now, the regional stock report we're looking at has assigned BMW an overweight stance, with a really solid 7 out of 10 reading. And the reason? A glaring inefficiency. Look, BMW is currently sitting at a price-to-earnings ratio of just 8x. Meanwhile, the intrinsic value estimate places it much higher, somewhere between 10 and 12x. And if you zoom out to the wider IFRS peer average, they're trading way up, between 12 and 15x. Essentially, macroeconomic fears have pushed the price down, leaving this stock at highly depressed levels compared to its actual fundamentals. Actually, market participants are treating it as overvalued right now, which is kind of wild because it's completely contradictory to what the core data actually shows. Moving right along to Section 2, by the numbers, a look at 2025 actuals. So, you might be wondering, does the underlying business actually support a higher valuation? Let's look at the cold, hard fundamental data. I gotta say, these numbers are staggering. We are looking at a market cap of 118.5 billion euros, which firmly solidifies its position as an industry leader. Revenue sits at a massive 158 billion euros, and that's being driven by strong automotive and mobility growth. The company generated 18 billion euros in EBIT with a really solid 14% return on equity. Really not too shabby for a supposedly overvalued company, right? And if you focus on the bottom line, they are generating a robust 12 billion euros in free cash flow, all while maintaining a highly conservative debt-to-equity ratio of just 0.65. Honestly, this is the textbook definition of a fortress balance sheet. And this immense financial strength, it directly fuels BMW's competitive edge. The analysis points out that BMW is currently ranked #1 in the luxury segment for quality metrics. Even against fierce, heavy-hitting competitors like Daimler, Volkswagen, and Tesla, BMW holds a dominant premium market share in Europe. They're pulling this off through incredibly strong brand equity, advanced EV innovation, and just a relentless focus on operational excellence and lean manufacturing. For us as investors, this means you aren't just looking at a car company. You are looking at a highly optimized, resilient profit engine. All right, Section 3, charting the technical setup, reading the market signals. Now, fundamental strength is really only half the picture. We need to look at where the stock is actually trading day to day, which right now is around the 105 to 107 euro mark. To understand the technicals, we first have to define a critical level, the 50-day moving average, which is sitting at approximately 115 euros. As you know, moving averages help smooth out price action over time, and right now, this 115 euro level is flagged by analysts as a vital support floor for the stock's future momentum. And the charts are definitely flashing some exciting signals. Analysts are watching for a confident bullish breakout above the heavy resistance line at 120 euros. This upward momentum is being supported by increasing trading volume, which gives us that solid volume confirmation we always look for. With the 50-day moving average providing that strong support floor we just talked about, the setup shows very positive technical momentum with highly defined entry and exit points. Let's pivot to Section 4, catalysts versus risks, weighing the scales. Because every good analysis needs to look at both sides, right? It's basically a fundamental tug of war. On the upside catalysts, we've got PEE expansion back to that 10 to 12x range, a potential sector rotation favoring quality names, massive EV and mobility subscription growth, and their continued cost reduction programs. But on the downside risks,
We face potential macroeconomic recession headwinds, intense, aggressive EV rivalry, those relentless semiconductor supply chain bottlenecks, and globally stringent emissions regulations. So it really is a classic battle between the company's internal execution and those broader macro-environmental threats.
Which brings us to our final part, Section 5, the trade strategy, actionable steps and positioning. So, what is the actual move here? How does the regional stock report suggest navigating this setup? Well, the ultimate recommendation is a very clear action: buy. They have set a target price of 120 euros, working on a time horizon of 6 to 12 months, and they recommend a position size of 5 to 8% of your portfolio. According to the analysts, this keeps downside risk limited while offering a highly favorable risk-to-reward scenario, giving you a 15% or more upside potential from current levels. Now, the crucial part is how exactly to execute this trade. The report outlines a really straightforward sequential 3-step playbook. Step 1 is the initial entry right at current levels, so between 105 and 107 euros. Step 2 is to scale in, meaning you make additional strategic purchases if the price happens to dip down to the 100 to 103 euro support levels. And finally, step 3 is all about portfolio management. Once the stock makes its initial gains and breaks out, you implement a trailing stop loss above 115 euros just to lock in those gains and protect your capital. Now, to make sure this thesis actually stays on track, the report provides a really handy monitoring checklist. Think of this as your homework for the coming months. You want to see that PE ratio actually start expanding toward that 10 to 12x range. On the technical side, you need to see a breakout that sustains itself above the 120 euro resistance line. Fundamentally, you're watching for quarterly earnings to beat expectations, free cash flow staying incredibly robust at over 10 billion euros annually, and a continuous reduction in that already conservative debt load. So we've looked at the deeply discounted valuation, the massive cash flow, the technical setup, and of course, the risks. The data absolutely paints a picture of an industry titan that is currently priced like an underdog. But as we all know, the market is entirely unpredictable. Will BMW's undeniable lean manufacturing and their aggressive EV pivot be enough to outpace those looming macroeconomic headwinds and secure that 120 euro target? It's a high-stakes question for the premium automotive sector, and it's definitely one we are going to be watching closely. Thanks so much for joining me on The Explainer today. Keep analyzing, and we'll see you next time.